Hey, Scott Winterton here with Platinum Home Realty and Platinum Mortgage. There's assigned video number 7. Okay, here we go. Lending. I know it's so boring, but we got to talk about how the loans work, okay? Because if you can't get the dough, you can't get the home. So here's the thing. Lending guidelines are different for each program, and each program is basically designed to help people who are in different situations, okay? Because no one is ever the same, okay? So for example, if you have a say a 600 credit score to say 640 credit score, I would be looking at FHA immediately. Okay, because they're going to be the most lenient with their underwriting guidelines. Okay, if you've got something where your credit score is 690, I may still go FHA because the hits on a conventional loan to the interest rate would make the payment even higher than it was even with mortgage insurance on the FHA loan. Okay, all things being equal, like the down payment being the same. So if you have like a 750 credit score and you've got 25% to put down, we're going conventional. More than likely, we're going conventional as long as it meets the loan to value because you're not going to have mortgage insurance as long as we're below 80% loan to value, which is going to save you money there. And the interest rate's going to be lower because conventional loans, the higher the credit score, the better the interest rate. Okay. FHA is not so interest rate driven with credit scores. Okay. So then let's talk about guidelines. Oh, and VA doesn't even have a credit score requirement. Beautiful. So if you're a veteran and you don't own a house, we need to talk because they're 100% financing and they're not credit score driven. Okay. They still have guideline requirements, but they're a lot more lenient to get loans through because you're a veteran. You've earned it. Okay. Um, so as far as guidelines go, what do they look for? All of these loans are going to want to have some type of income, let it be a regular job or if you're on retirement, pension, Social Security, they want to see money coming in. Now, they do have loan programs called asset depleting, which I'm not going to get into that. Just know that if you have a lot of money in stocks and you don't have any other money coming in, you can actually use like annuities and things like that to qualify as income. Okay. But back to the rest of the world, your W 2 income, your paychecks, they're going to look at your year to date income to make sure that you're working about the same amount of hours every week, looking for stability in the lending guidelines, and um, the total amount you make every year. They're going to look at past W 2s to give them an idea of history and base your income off of your current pay stubs, current hourly wage, and then they'll take an average of overtime if you get it, and you're at your same job for 2 years. They'll use an average of the income there of your 2 years of overtime and bonuses. If you get a bonus, they will count bonus as income as long as you have a 2 year history that they can average. Um, Other than that, they're going to be looking at things like payment history on your credit report. You may have a 650 credit score, but you've had two 30-day lates on your current mortgage. That's going to be a problem. So it's not always cut and dry. Oh, I've got a 650 credit score. I'm going to get a loan. It doesn't work that way. I've had doctors get declined for loans because they had 600 credit scores and were actually broke. They had all this money coming in, but they on their credit report, they had an absolute ton of money going out. And they don't realize that debt to income ratios matter. So if you've got three cars with $800 a month car payments on each of them, your $10,000, $15,000 a month income isn't going to cut it because then you got to add your house payment to it as well. Okay. So we look at everything. When lending comes across, when I do the pre approvals, I look at lending guidelines and do an actual automated pre approval through Fannie Mae. Okay. So what is that? Basically what I do is I take all your information. I take your employment information, your income information. Your basically I look on your W-2s and your pay stubs if you've got them. And then I put it all into the software for a loan pre-approval. This is actually a pre-qualification, but once I do this and you give me the W-2s that back up everything you said, now it's a pre-approval. And it tells me if you're approved eligible or if it's refer eligible, which means you're eligible for a loan, but there's going to be restrictions on it. And that's when we start digging in deeper and go, okay, we may have to put more money down. It may require more things like reserves, which reserves are how many months worth of house payments do you have in an account after we close? Okay, because that means the bank goes, oh, everything's okay. If he loses his job tomorrow, he still has 3 months worth of house payments in the account, so we're okay with that. Okay, so that's what reserves are. And each loan program's guidelines are different. Okay, like bankruptcy. On FHA, if you've had a bankruptcy that was discharged 2 years ago, you can get a loan. On conventional, you can't. You have to wait 4 years unless the bankruptcy is due to medical, but very rarely do they accept that. So FHA has its guidelines about BK being 2 years. Conventional has it for 4 years. And these are the things, this is where I come in with 20 some odd years of experience. After you and I talk and you tell me your story about, what situation you're in, your income, a little bit about your past, I guide you to the best loan program that you've got the greatest chance of getting approved for with the lowest interest rate. Because again, I want to get you the lowest interest rate because that means you get the lowest payment, which means you can afford more house. So you're more than likely going to find the house you want. Um, with a lower interest rate. Okay, those two things are pretty important, especially when you're in the 250 to 350 range. We want to get you the lowest interest rate we can for the lowest payment so you qualify for more house. Okay, because we want you to get to a house when you come home and you're excited. Like, that's my house. Okay. So that's about it on lending right now. I'll get in deeper once we actually get into a loan and I do a pre approval and you'll get a better handle on it. All right. Next video coming up and gonna make it a surprise.